There we go.
It is 4 o'clock. So good afternoon, everybody who has joined us. Welcome to Baldwin Family Office's discussion on tax mitigation strategies for the 2020s. Whew. The 2020s have been quite interesting for us tax preparers and planners. And I don't think we're going to be able to settle into any kind of routine anytime soon. So this is a very timely topic as we go into 2022. So I'm Eric Meck. I'm one of the founding members of Baldwin. That founding occurred way back in July of 1999. So we've seen many changes in taxes and investments since then. I've been working with some of the members of Baldwin in the family office setting since 1990. I specialize in tax preparation, planning, and private foundation accounting. And allow me to introduce Richard May, Managing Director of RKM, our affiliate down in Westchester. He developed today's program and will be the primary presenter. Richard, thank you for putting the work into preparing today's program on top of the already ramping up workload of tax season 2022. I think we're in for another bumpy ride this prep season, but hopefully not as bumpy as the past 2 years. We shall see. But before we turn things over to Richard, and I'll let him talk about himself a little more in 30 seconds or less, since we only have 25 minutes, I'm gonna turn things over to Christina McCloy. She's Baldwin's technology guru, among other hats she wears at Baldwin, to talk about the rules of the road for today's Zoom meeting. So Christina.
Yes, hi everybody. I just want to make sure that everybody can see the screen. You should see a nice pretty blue geometric shape with says Baldwin Family Office Roundtable Discussion. If you cannot see that, let me know. All right, I will click through this then. We will get started. All right. We're just going to go over real quick our Zoom conference etiquette and instructions. While the presentation is happening, we ask that everyone keep yourself on mute as to deter any distracting background noises that might inhibit our audience from hearing the data that is presented. During the Q&A session at the end, we will ask that everyone continue to stay muted and use the raise your hand feature to add yourselves to the queue to voice your question. Once selected, you will unmute yourself, ask your question. Once your question is answered, then we'll put you on mute again. How you do that is, here's a little visual. Down here, here's your screen on how to raise your hand. There's this little button down here called reactions. If you hover your mouse over it, you'll see this menu pop up. You can click on raise your hand. And then when you're done, you can just hover over the same button and then click lower your hand, and that'll take you out of the queue. If you are joining us by phone, the way to enter the queue to ask a question is you will dial *9 on your phone. That will add you to the queue. The host will unmute you and ask you to present your question. Once you're finished, you should dial *9 again, and that will lower your hand and take you out of the queue. And that is the very basics of that presentation there. So if you have any questions, you can also add to the chat in the group and I will respond accordingly. And now we can bring it right over to the presentation.
Terrific. Well, thank you all for attending today. Peter Havens, who's the principal of Baldwin Investment Management and Baldwin Family Office, asked me to give this presentation on taxes, and he also added, please make it interesting. Making a discussion on income taxes interesting is a challenge, but I've tried to add a little bit of personal experiences and when Eric talked about a story, maybe some stories can flesh out some of the tax topics that we're going to address. Just a little background on me. I'm a Princeton University graduate where I learned absolutely no skills that have anything to do with either investment management or tax preparation. However, in getting my MBA at the University of Michigan, I specialized in investment management and tax accounting, which gave me exactly the skills that I needed to pursue the work that I do both as in investments and in taxes. I started the firm way back. Eric mentioned that he goes all the way back to 1999. I go all the way back to 1980. There are probably some people on this call that weren't born yet in 1980. So in sensitivity to that, things were a little different in 1880. And actually some of my comments will address those differences. I have been on a side, I say a side business, but it's more a side enterprise that I've done, is I've directed investment capitals to some public projects in Westchester, Pennsylvania area, including the renovation of a Westchester Public Library and the acquisition and renovation of an armory, turning it into a performing arts center. So actually that's been both a tax and an investment challenge that enables me to bring some tools to the table for this discussion. Just briefly, the first project we worked on was provided a 6% interest return during the 2008-2009 meltdown. The second project had some tax credits that were as much as 50% of the original investment upon the launching of the theater, and then a 3% return for 5 to 6 years after that. The current project that I'm working on, which is in Coatesville, Pennsylvania, is an attempt to provide an annual return equal to the rate of inflation, which unfortunately is going to be a little bit more robust than it has been in the past. But back to taxes. When I started in 1980, the rates of tax were the highest in a generation. Routinely, our clients were in 40-45% tax brackets, and those were pretty much average people. Actually, Christine, could you move to the next slide? Thank you. Routinely, people were in 40-45% tax bracket. It was not unusual to have somebody having some income taxed at 50%. And I remember one poor gentleman that was on Social Security and worked a part-time job, and his marginal rate of taxation actually was very close to 90% because he had to pay back his Social Security and pay taxes on his Social Security and pay taxes on his salary. In contrast, in 2022, taxes are at historic lows. Not only the tax rates after the tax reductions in 2017 and 2019 at record low, the lower interest rates make tax planning important, as well as wealth planning, because we have the highest gift and estate exemption amounts that we've had ever. And they're presently scheduled to sunset after 2025. So the $11.7 million credit that exists today will sunset to $5 million in 2025. And it may be lowered earlier as we get into some discussion about the progressive era that we're likely entering. Not to mention, there's a lot of uncertainty about future tax rates. Pretty clearly, the deficit spending that we're undertaking now is going to require some payback, some payment of taxes to cover some of those deficits as they accumulate through time. Plus, it's a determination of the current administration to begin to move taxes in the opposite direction. We're likely to see tax bracket creep, and I have a slide coming up in a second which defines tax brackets a little differently than we're used to viewing them. Not to mention that there are all sorts of taxes coming from all sorts of different directions. Clearly, they're the typical taxes like income taxes and Social Security taxes, FICA taxes, but there's also the state and local sales taxes, estate taxes, inheritance taxes, they're coming from all directions, and they're likely to continue to do so. So you can't just focus on the federal income tax anymore. And we're dealing right now with, this is good news, bad news. We're dealing with a somewhat dysfunctional tax system, especially at the federal level, but also at the state level. The IRS is considered kind of broken right now. There's an article in the Wall Street Journal recently that said, good news, tax cheats. The IRS can't keep up. They've got something like 5 million letters that they're trying to process. And they recently got the okay to hire 5,000 return processors. And the most recent report, with the 5,000 openings, they've been able to hire 179 people. So obviously the IRS is having the same kind of problems that a lot of logistics companies and different companies are having. And when it's the Internal Revenue Service, that's the source of revenue to pay for our federal government. So that's a bit of a problem.
Can I say a little bit about the dysfunction?
Please.
Yes. So this is something that is kind of near and dear to my heart, because we've been dealing for this for the last 2 years. And I can say, because I just did a little study on this, because I'm burning a whole lot of time, but 30% of my clients have received erroneous no human contact notices in the past year. When I say no human contact, it means they're automatically kicked out because your tax return goes and sits on somebody's desk who's been furloughed, or the office is closed because of COVID. I have one group of trusts where we reissued checks and mailed them 3 different times. And each of those sat on somebody's desk until they became stale, and the payments were stopped by the banks. So it seems like Ogden, Utah branch is the black hole of tax preparation. Something goes there and it just disappears forever. Now, I don't want to pick on anybody, because I do know some very, very great professionals who work for the IRS, but they're just under budgeted, understaffed, and they went through the same things we've gone through with the pandemic. So I guess what I wanted to say to everybody out there as taxpayers, when you get a notice, please do not assume that the IRS is correct. I have some clients who said, well, I just paid this because, the IRS sent me the letter and said they were going to levy my assets. I said, no, please do not panic. And don't assume that your tax professional is the one who is wrong either. We don't like to be accused of things like that. As soon as you can, if you get a notice, get it to your tax preparer. We'll get it sorted out. And, there's no reason to lose sleep over it, because so many of these, like I said, are totally erroneous and had nothing to do with any human that checked anything. Just a set of circumstances happened that flipped the switch in the computer and said, send this person a notice. So that's really all I need to say about that.
Thank you, Eric. And that reinforces my message. And the state's probably not as bad as IRS, but still having some problems as well. Christina, could you go to the next slide? This is a different view of most of you are used to seeing tax brackets, which looks like something off a college board exam. This is a different way of looking at it, because rather than dealing with marginal tax rate, I'm presenting something that's average tax rates, which is probably a little bit more meaningful. A lot of people don't get the concept of a marginal tax bracket. You might have a little bit of income that sneaks into, let's say, the 32% bracket, and it might have you saying to your friends, I'm in a 32% bracket. No, you're not. It's just some of your income snuck into that bracket. This is more illustrative of the real cost of the federal taxes. And this is just income tax. This isn't FICA, it isn't Medicare, the top 4 lines. And part of it is the first $26,000 worth of income for a married couple, $13,000 for a single person. is tax-free because it's the standard deduction. So once you start adding income to that standard deduction, very quickly you get up to 110,000. And on the first 110,000 of income, the tax is only, still a lot of money, but it's only $9,500, which is about 8.6, slightly under a 9% tax rate. On the next $260,000, which is a lot of extra income on there, you first go into 22% bracket, then you go into 24% bracket, and the average taxes there is at 23%. So if you're, way to read this, if you have 110 plus 260, that's 370. The tax is 60 plus the 9, so it's 69,500. Above that, once you get above that 370, the next 300,000 is taxed at 33% on average. Again, partly at 32 and partly at 35%, but an average rate of 33. And then above $670,000, for those of you fortunately not enough to have that kind of income, the tax rate above that amount is 37%. And of course, on top of this is the FICA and Medicare tax. On the first almost $150,000 worth of wages, it's 7.65%, which is matched by the employer paying another 7.65%. And then above that level, you only pay the Medicare tax, which is 1.45%. There is also a Medicare tax on net investment income. And that's that's a rate of 3.8% when income gets above $250,000. And I promise these are the last numbers that I have in this presentation. The rest of it's more concepts. Next slide, please, Christina. Eric, do you have any comments on those tax brackets?
Go right ahead.
Okay. The traditional approach to saving money on taxes, and again, this I'm looking at first traditional, then more progressive approaches, which means really more creative, and then finally what we're likely to be looking at in the future. The traditional recommendations are to defer income, just with a simple philosophy that paying tax next year is always better than paying tax this year. So you get the benefit of the time value of money. Accelerating deductions means if you're on the fence about a contribution in 2021 versus 2022, having taken in 2021, unless there are other extenuating circumstances, it's better to accelerate those deductions. However, if there's a change in tax bracket, if somebody's going to vault into a higher bracket, obviously you might take into consideration some active tax planning on deferring versus accelerating. Something that's done a lot recently, because the standard deduction is now claimed by 95% of taxpayers. So only 5% of taxpayers are still itemizing deductions, where it used to be something like 40% of taxpayers. Unless you have a lot of medical expenses or a lot of charitable contributions, the fact that taxes are limited to a $10,000 deduction, and a lot of people especially by their retirement years, don't have a mortgage anymore, they're probably stuck with the standard deduction. However, if you bunch deductions like charitable, instead of giving your traditional $5,000 a year to your church, you might consider a $20,000 deduction to the church and then tell the church to pass for the next 4 years. You have to convince them the year you have 20 that this is not an annual occurrence, though. And also something that's used by a lot of taxpayers, especially when it comes to some financial engineering that's done by some really creative attorneys and accountants, is the use of LLCs, which is possible to create, to differentiate income from perhaps its original source, or other legal and tax savvy entities. For instance, a C corporation now pays a lower tax than it used to. So not very many small businesses were using C corps. Most of them are using S corps. But now the C corps is a possibility because the rate's lower than the the corresponding higher rate on individuals. Comment, Eric, on traditional approaches to savings.
I guess that there's just one thing in there that also should be used as much as possible, and that's just the transfer of assets between the different generations. I just had one that kind of unfolded over a period of 3 years where my clients and I had a 10-minute conversation back at the end of 20, I guess it was 2019. And they asked me, should we just gift stock to our kids, appreciated stock, or should we use cash? And of course, I said, if you have the means to do the stock and your kids don't need the cash right away, please go ahead and do that. And, then after all this unfolded, you figure it was mom and dad giving the maximum amount to a newly married couple. So it was $60,000. Mom and dad were up in the highest tax bracket. So they were paying, at that point, I guess it was 39% plus the net investment income tax. And the kids were just starting out in their careers and starting out at the point where they were accumulating assets. So there was a tax rate differential of almost 20%. So 3 years of collecting those dividends, a 5% dividend, and saving the taxes on that was a few $1,000s. And then the kids went and sold it. So of course, mom and dad being in that upper tax bracket, they would have paid 20% capital gains tax plus the 3.8% net investment income tax. The kids only paid 15%. So just that 10-minute phone conversation over 3 years saved $10,000 for that family. So my message here, it almost seems like I always have a message. Do not be afraid to call up your tax preparer and talk about things. They might turn on the time clock, but my time clock for that probably added up to $75, and that family saved $10,000. And if you do that with a few different items on your tax return, that can have some real power. So tax planning, very important. All right, Richard.
Yeah, thank you, Eric. And just to add one thought to that, the legal profession for a while was regularly recommending family limited partnerships, where investment assets could be put in a partnership, the ownership gifted to the next generation or even another generation, and some of the income would be attributable to that next generation without having given up control of the assets. So that's used. I don't know if that's used as much anymore, but it had a very useful tax savings for generations. Christina, could you flip to the next slide? Thank you. Something we've used a lot in the last 5 years are Roth conversions. And specifically when a individual or a couple reaches a retirement, and before the need to start taking required minimum distributions from their IRAs or their 401ks, they're generally in a lower tax bracket. So we've been doing a lot of Roth conversions between, say, age 65 and 72. A lot of people think of Roth conversion, you think of taking, $500,000 or $100,000. We've been doing it for like $20,000 a year for 5 or 6 years, which significantly gets assets into a Roth from the rollover IRA before the RMDs kick in. The two advantages, of course, are Roth IRAs, the distributions when it comes out are tax-free. And although they've changed the rules, they've made them a little more restrictive. The next generation can still take tax-free distributions from an inherited Roth IRA. So that's one advantage. The other advantage is you're making your IRA or your 401k plan smaller. So that when you get to age 72 and have to start taking your minimum distributions, the minimum distributions are slightly smaller. So what's happened today is a lot of people are landing in a higher tax bracket at retirement because they have deferred their Social Security to 70, and they've deferred taking anything out of their IRAs till they're 72. All of a sudden, they've got way more income than they need, and they have to pay tax on it. So if you spread that tax liability off over, an early retirement, it pays dividends later on. A second thing that we've been doing a fair amount of is charitable trusts. Both, maybe a lot of you heard of charitable remainder trust, which basically would be you get the income from the trust during your lifetime, and at your death, it goes to a charity. There's also something called a charitable lead trust, where the charity gets the income from the trust, and at an expiration of a term of giving to the charity, you either recapture the assets from the trust or have it distributed to the next generation. So with interest rates low and with tax rates low, this has been a useful device for savings taxes as well. And as Eric's already talked about, ownership of assets and attribution of income, if you can have assets owned by the next generation, it avoids in Pennsylvania, avoids the inheritance tax. Attribution of income, as Eric explained, kids are often in a 15 or 20% tax bracket compared to a lot of retirees that are in much higher tax bracket. Just to mention a couple other things that are useful today, the HSAs, health savings accounts, you can accumulate up to $8,300 a year in an account if you're still working, if you're over 55 and still working, and that amount can only be taken for health deductions while you're a certain age, but at a certain point, it's eligible for other distributions as well. And of course, maximizing retirement plans, 401k plans, 403b plans, simple IRAs, and Roths are always helpful. Capital gains and dividends are still taxed at a preferred rate. So I don't know how much time we're going to have at the end, but I often advocate owning your most aggressive assets in your Roth because that asset is never taxed. Those gains are never taxed. To the next slide, Christine, if you would. I'm sorry, Eric, do you have any comments on those last few?
You pretty much hit it. The only thing in the charitable trusts, I want to mention that there's also the option of a private foundation, which, some people think you've got to be one of the mega wealthy families to have one of those. I've seen them start up, small and just they're contributed to on an annual basis, and they can become something quite substantial. The nice thing about those is they tend to be multi-generational. Some of the private foundations that I work for, they're in their third generation now. The grandparents started it, and now the grandkids are running it, and it's a really nice way to express your family values. So that's just a really nice way to distribute your wealth if you are philanthropic in nature. And so just keep that one in mind too.
Thank you. Mm-hmm. And starting to build toward a conclusion, since we're at our 25-minute mark, we did a program earlier this year on the Build Back Better bill. that if you call it the Biden Build Back Better bill, you got a ton of B's. Tax rates are threatening to go up. At least some of the senators have said they're sympathetic with some of the provisions in the Build Back Better bill. I think it's sort of inevitable that there'll be tax increases over time. The provision to raise, I think likely to raise corporate rates to 25% from 21 is likely over the next couple of years, but that's not going to provide a whole lot of revenue. So as I say in the last line on here, the IRS knows enough, or Congress knows enough to go where the money is, and there'll be what could be described as an assault on wealth. The more liberal among us might say that there'll be some more equity written into the tax code. But either way, there's probably likely to be more taxes and more provisions that are costly as we move through time. And Eric, any feelings about this?
No, we're still kind of in a holding pattern. Most of these provisions that almost seemed like tax Armageddon back in October of last year looked like that was heading our way. It got caught in the political quagmire, and there just really hasn't been much that is happening since. But I think you're right. It is inevitable that some of these things will be happening. So it's just really important to keep that in mind, and that there will be changes, and we always have to be evolving with our planning and how we're reacting to things.
And just a brief, thank you, Eric, and just a brief focus on history. Christina, could you flip the slide? And this will be very brief. Just a brief history of where wealth has been located in the US over the course of the last 200 and some odd years. Most of the 18th century to 1860, most wealth was held in land. And, you know, obviously, first of all, land owners were the ones who voted. And, but when it came to pay for services, people looked to taxes and levies on land. And then from 1865 to 1900, it was a little bit of the go-go time of the railroads, and lots of wealth was created in this country, both in the North and the South, but especially in the North. And it led to a progressive era that started really pretty much right at the end of the 19th century, and went really through the 30s, and then we had a war, and it wasn't until 1980 where all of a sudden there was some accumulation of substantial wealth again, which has been going on 40 years, just about the same amount of time that happened 120 years ago. So flip to the next slide for the projection of this thought. Is I think we're probably entering the likely of a new progressive era where rates will start moving higher. There likely will be more taxes and more provisions that will level out the playing field in a way. But something that's a little different is wealth is held in a different format than it used to be. So it's going to be a little harder than just taxing income or just taxing real estate. And I think the challenge to the tax people is they have to, first of all, find out where the money is in order to tax it. But you know they're going to have to construct a more functional IRS in order to collect those taxes. Or they may start the whole thing over and create another agency that replaces the IRS, because the IRS is, according to that article in the journal, about to self-destruct. Encouraging you to use appropriate entities and title assets properly. And the last thought is something that I feel strongly about, is locating your growth assets in your Roth, your income assets in your IRAs, and your dividend assets in your taxable accounts is right now the most tax efficient strategy. And I think that's where I end. Yes. So, Eric, any thoughts on this? And then we'll go to Q&A.
I think we should go to Q&A at this point, given the time. But thank you, Richard. That was an excellent presentation. And again, to be doing that during the rush of tax season, that was very much appreciated.
Thank you, Eric.
Just give a reminder, if you want to ask a question, on the bottom of your screen, if you're joined by computer, you just click on that reactions button, and there's an option there to raise your hand. If you're joined by phone, hit *9, and it'll put you in the queue for your question. Give it a few moments here to see if anything pops up.
One of the few times in taxation that there's fewer questions than answers.
Oh, here we go. We got some. All right. Lucy, I'm going to have you, you're unmuted, so go ahead and ask your question.
The lack of questions made me feel empowered to ask this question. You started to talk about where one could put assets for tax mitigation, and listening to this discussion, which is fairly high level, and perhaps there aren't a lot of questions because people are thinking about their own individual situation and can just ask y'all on the side. But perhaps this is a little bit more general. So the question is, this made me wonder about a little bit more of the details, if you could say, about how to set up a charitable foundation and how that, what that could do for me. And, you know, if you could just sort of maybe give us some more details on what that might look like.
Okay, so the nuts and bolts of setting up a private foundation, of course, the benefit immediately would be a tax deduction, just like if you contribute property or cash to a charity, you could contribute property or cash to a private foundation. Generally, your limitations are a little bit stricter. Over the last couple of years, you could actually give 100% of your AGI to public charities, but with a private foundation, you would be limited to 30% of your income. Or if you're giving appreciated stock or those kind of assets, you'd be limited to 20% of your income each year. And like I said, when you set up a foundation, it's not limited to just that inception year of the foundation. A family can continue to contribute to that foundation. Now, usually it's a good idea in a high income year to match that with the year you're going to set up your foundation. A private foundation is a very strictly regulated entity. There are very strict rules of the road, which I'm not, we could probably do that with an interested group of clients if we'd want to discuss that in a future presentation. But generally, using a lawyer to set up the charitable trust, or it could be set up as a corporation. So, of course, to get all that paperwork done, a foundation normally has a board of directors. Let's just say $1 million is put into a foundation to start it up in any particular year. What happens is that private foundation is required to distribute 5% of that on an annual basis. So you would put out that 5% of charitable contributions to other charities. During that year, everything else would remain in principle. So over the past couple of years, a lot of the private foundations have gained 20 to 30% in assets. So you're only giving out that 5%. So it really helps that nest egg grow. And then the following year, your 5% is based on that asset that has grown by the amount that was not distributed. So it might be worth 1.2 million at that point. And as I said, one of the real benefits is a private foundation doesn't necessarily go away when a founder is deceased. It can be passed on to the family members, or it doesn't even have to be family, as long as there are trustees that are appointed. It can outlast the founder and keep their charitable intentions going.
Eric, if I may add one more thought to that. There's sort of 3 levels of charitable entities. One is a public charity, which is sort of the highest level. Then there's an operating private foundation, and then a non-operating private foundation. A non-operating private foundation can only give contributions to other charities. An operating private foundation can actually act a little bit like a public charity in the fact that they could actually conduct charitable activities. Most people, unless they're actively entering charitable work, would use a non-operating private foundation, which is what Eric's mostly talking about.
Yep. Does that give you a good enough primer? And maybe we can have a discussion at a later time on that.
Yeah, that was really helpful. Thank you.
Okay.
I guess I'm specifically interested in a set of assets that involve an LLC that have low income rental properties. And so I think I'll follow up with y'all on that.
Sounds good. There are a lot of rules involved. It's a very heavily regulated area just because it was a much abused area in the past. But we won't get into that.
Richard, if you could just expand a little bit, there's a question in chat on the different types of what you have in your Roth versus your IRA.
Yeah, and obviously, it's not like it's crystal clear that something is just a growth asset or something is just a dividend asset, but as a general rule, the more aggressive investments we believe should be in a Roth IRA because the growth is never taxed. An IRA, as the money comes out of an IRA, is taxed at ordinary income rates. So you want to at least have your interest and high yield securities in there because you're not giving up any attribution of tax. And then your dividend paying stocks, because dividends still in the present tax law get a preferential treatment. Dividend and capital gains would be in your taxable accounts. So you know your Johnson & Johnson in your taxable account, your General Motors bond in your IRA, and your ARC Innovation Mutual Fund in your Roth IRA.
All right. Anyone else? Oh, here we go. Elizabeth, go ahead and unmute yourself, ask your question.
Yeah, you didn't talk much about the 1031 exchanges, but given the situation that you think, we're kind of headed into a increasing tax environment, is, kind of executing a 1031 on commercial or investment properties a smart thing to do in order to save generational wealth, as opposed to, I know you talked a little bit about, the cash or giving stock. Just curious what your take is on that.
Yeah, thanks, Liz. The two comments on real estate. Obviously, is a great investment, and it's a tough investment to hold in any account other than your own name. It's tough to hold in an IRA, and it's probably not a good Roth investment. But the 1031 exchange, which I think everybody expected that to be a casualty of the current tax changes, it even survived in the Biden bill, and it's very useful. Again, you're not eliminating the tax, you're deferring the tax. However, it might be combined with the opportunity zones, which is another real estate provision where somebody that has a capital gain through either real estate, stocks, or a small business can put their gains into an investment, a real estate area, which has been designated opportunity. For example, in Chester County, Coatesville, Pennsylvania is considered a opportunity zone. So there's plenty of ways to save money in their investment of real estate, not to mention depreciation itself is a great tax device. Eric?
I think you hit it on that. I wouldn't add a whole lot to that comment. Unless we want to make it a whole topic that would last us about an hour.
Well, I'd love the topic, because again, if you think the rates are going to increase significantly, it's like, do you do it now or do you wait 10 years? And now it's gone from 20% to 40, right? And maybe all of your gains has been kind of given back. You would.
Yeah, it's a little bit of a probability analysis, but I hope that there'll always be some preference for real estate, and I hope there'll always be some preference for capital gains. I would just be surprised if it stays as preferential as it is.
Especially given some of the recent legislative attempts at changing that. It's been a target.
Great, thank you.
All right, gonna do one more call for any other questions.
Almost time to get back to work, Richard.
Yeah, I know, Eric.
All right.
It's been nice talking to everybody, but looking at the calendar.
Tomorrow is March.
I think we have the end of the questions, so I think that's all we got for today.
Okay. Well, thank you for joining us. I was just looking through our view here of all of our participants. I'm seeing quite a cast of characters here, and it looks like our numbers have grown a little since the last time. We're going to shoot to do this on a quarterly basis, so our next one should be in the summertime after tax season. So you'll get to see me without the tax beard. Richard?
Thank you. Thank you, Eric.
And thank you, Richard.
And Christina, thanks for hosting.
Thank you, Chris.
Very welcome. Everyone, thanks for joining. We wish you a great evening, and we'll see you next time.
Happy March.
Thank you. Thank you.